Michael, thanks for joining us. Michael is from Frazis, Frazis Capital Partners, and we're super thrilled to have you on. Michael, I've been following for many, many years. I'm an investor in the fund, and we'll get through that detail. But I've got a really interesting first question, which has sort of been ever since we decided to do this. How's a guy that has a Master of Chemistry end up in funds management?
Well, I think it's a good question, and if I knew what I knew now, I probably would have stayed in chemistry a bit longer. But I think you're young, and for me, I did chemistry at Oxford in the UK, and then did a master's of research. And the lab work probably wasn't for me. But you also, in your early 20s and doing a 3, 4, 5-year PhD just seemed like an unimaginably long period of time. As you get older, you realize actually that's not that much time at all, and it would have gone like that. And there's only certain points in your life that you can actually do those kinds of things. But at the time, I just wanted to kind of get going, and I found finance really exciting. Lots of people involved, obviously the big sums involved. It's kind of very exciting to kind of a young person that just wants to make their way in the world. So that's kind of what happened. I got my first job in London in finance, working in private equity for about 5 years, and then set up my funds business.
Yeah, right. So talk us through the history of the fund and how it sort of came to be, and obviously it's been an amazing. We'll probably get to the detail, but over the last call it 4 or 5 years of COVID and all that, there's been massive ups, massive downs. Talk us through sort of the evolution of the fund and some of those changes that you've seen.
Yeah, sure. So started in 2016. It was with a tiny amount of family money, like in the hundreds of thousands, like that kind of ballpark. Did some good returns, and then decided actually to do it full time and launched a new fund, which is the current fund. And as I'm sure you're aware, it's a difficult business to be in. It's very competitive. People can buy, a boat, a holiday house. They could invest in an established manager. They could buy stock. They could buy another property. There's so many different things that people could do with their money. So it's pretty hard when you're young to kind of raise money. But we kind of got lucky and unlucky in the fund at different times. So there was a moment where we kind of decided the stocks that have worked for us are those companies with true customer love and explosive growth. There's things like Tesla, Apple, some Xero in Australia. They were the things that drove all our returns. So we decided to just focus just on that part of the market. And then I guess we're one of those managers that when COVID came around, we had a really tough drawdown. But it was very different to kind of the drawdowns that came after, in the sense it was very fast. It was a couple of weeks really, maybe a month, high to low, and then a very quick rebound. But we just so happened to be perfectly positioned for what came next, the year that followed, where there were huge lockdowns, governments all around the world, gave people a ton of cash in subsidies. They pumped a lot of money into the markets, and then things like just the simple stuff, like how much time do you have in front of the screen, that all rocketed. So anybody who was positioned for tech, and were positioned probably more aggressively than most, did exceptionally well over that period. And that's kind of what drove our returns. And then we kind of raised a lot of money over that period, by our standards anyway. It's still small relative to funds management standards. But yeah, then things kind of changed in 2021. So in 2021, kind of the beginning of that year, sectors like biotech started selling off throughout. Chinese tech also went from being like one of the best performing sectors into a drawdown that's really went on until maybe a week or two ago. It seems like there's a bit of life in the Chinese market at the moment. And I guess we kind of took the view that the sell-off that came in 2022 would be a short one, 3 to 6 months, and that didn't play out. It ended up being much longer than that. But it feels like in the last year or so, the story has become much clearer in terms of what's going to work in this period of the market. So many of those growth stocks, they're called growth stocks, but they're barely growing now. Companies like Shopify, all the software businesses, they were hitting 40, 50, 60% a year for, most of them weren't listed for a decade, for at least 5 to 10 years. All that's kind of stopped, and now they're kind of at 15 to 20% top line, and many of them haven't reached profitability. Similarly, biotech continued selling off. Chinese stocks didn't recover. So those kind of red hot markets in 2020, and really kind of arguably the 20 years leading up to 2020, or the 18 years, everything from the bottom of the original tech crash in 2000. A lot of that stuff hasn't actually recovered. But in the meantime, there was that extraordinary revelation, that scientific advancement in AI and the fact that large language models were vastly more effective than anybody would have predicted. It seemed magical when you first had that computer, when you're talking to a computer and it's talking back. And that's triggered a huge boom in investment and also revenues going to those companies. So I think it's pretty clear that that's where the market is going. In this regime, it's probably been going on for a year. It could go on for 5 years. It could go on for 5 months, 5 weeks. Who knows? But in this current regime, that's where the money's flowing. That's where the revenues are going. That's where the additional corporate spend is going. And that seems like the best way to position. And we've been kind of lucky that we've been on that trend pretty early. And that's helped us in the last kind of 6 to 12 months.
So, Michael, you mentioned a lot of tech companies. Are you looking at more startups or companies that are a little bit more mature, sort of at that start of that hockey stick growth? Or what do you look for with regards to some of those companies?
We have a small VC fund. I'd say that the investments have been successful. Have mostly been friends, right? And we're the first investor in. And then, they've gone from zero to, a few $1 million in revenue, something like that. That's kind of what's worked best for us in the VC. Originally, we launched it to do a pre-IPO fund. So again, talking about cycles, how much things have changed. There was a few years where pre-IPO funds made an absolute killing, and everything just seemed to work. You'd get a 25 to 30% discount on an IPO list. So you'd get that, if you're 75 to 100, that 30 to 50% pop on day one. And often the IPOs would do really well. And then those funds raised a lot of money. Then from 2022, that market was completely shut. And a lot of money went in to these kind of mature companies that are unable to list now. And that's become a really challenged part of the market. But in private side, the stuff that we find most exciting, most interesting is actually the really early stage stuff. And we have one kind of brilliant founder that we're helping set up a venture studio with so we can do more of that early stage stuff. In our fund, we've always focused on companies that are really delivering on revenue and kind of product growth. So what are the core KPIs? Is like the number of users growing really fast. Is the revenue per user growing fast? Are they making more money? Is there good operating leverage? So they're making more profits as they grow. And that part of the market is still doing pretty well. They're very kind of independent ideas, but they're much more mature in a sense. These are multi-billion-dollar companies, not necessarily, tens or hundreds of billions, but they're very mature companies, and you can really see their performance, and you don't have to guess as to whether people are going to like what they're doing because, every quarter they're bigger, better, stronger.
So, there's so much noise, from someone that is obviously invested in your fund and takes an interest in this stuff. There's a lot of trying to cut through the noise, and you look at, probably something that I want to dive deep into is, everyone, that we talk to is, sort of fascinated by the AI story. And then obviously our client base is, and we've got a number of high net worth individuals and family offices and all that sort of stuff. And subsequently they ask a lot of questions in this space. In terms of that whole AI story, the hot topic that on everyone's mind is probably NVIDIA. They sort of the one that is everyone can sort of relate to. And for those that don't know, NVIDIA is the designer of GPUs, graphical processing units. Probably first known for the designers of graphic cards for video games, and that sort of translated it some years later into crypto and crypto mining, and then and obviously then for also that those that don't know, those cards are now heavily used by language models, the learning of language models, and what is essentially AI. You look at a company as large as they are, and they're just doing astronomical numbers, and I think I'd may stand corrected, but they sit at an astronomical PE for the size of the company. How do you go about seeing, obviously you can pay too much for these companies. How do you go about valuing a company like that? I mean, it's hard enough valuing something that's tiny with potential of massive build out and revenue into the future. But what do you do for a company like NVIDIA where it stands today?
Well, the interesting thing about NVIDIA is, and actually most of the semiconductor companies, is they're very different to the software and loss-making companies that did well in the 5 years up to 2021. These companies are making a lot of money. And, it's trading on a forward P of 30 times, but, it's gone from, 15 to 60 bill revenue really, really fast and is making extraordinary margins. That investment, the story is incredible that they went from, just being good at graphics to then crypto, and now it's just perfect for these large language models and specifically matrix multiplication. And it's so obvious in hindsight. It wasn't obvious the whole way through. It might have been obvious to them. The idea that you just run calculations in parallel rather than in a single thread. Like if you just put it that simply, it's so obvious that's a better way of doing, large complex calculations. But really they're the only people that made the investment many years ago. So they developed their own software platform, CUDA, which allows people to actually access that multi-threaded computational ability. And there's no one really, AMD has ROCm, but that's, very much poorer cousin. The vast majority of development is done on NVIDIA GPUs. So for them, it's a strange one, because if you look at their numbers today as they stand, it's not crazily expensive. Like I said, 30 times PE for a company growing extremely fast. The question is this, are we in the middle of a build out of overcapacity, and is there some kind of crunch? Because that's happened to NVIDIA so many times. It happened to them like twice in the last 3 years, where you go from like immense demand for NVIDIA chips for Ethereum mining to all of a sudden you can see them on eBay at like massive discounts. And then before you can even blink, all of a sudden they're in massive demand and they're sold out, a year plus in advance. So I think it's more that. It's less like, as it stands today, if this is a steady state that continues growing, extremely cheap. But the risk with semis is there's that, overbuilding capacity. Everyone's over ordering. There's a lot of companies that were set up that are buying NVIDIA chips. Like, how many large language models will they have? Will we actually have? If you have OpenAI and Microsoft, Google, and then Meta as an open source alternative, where does the 4th, 5th, 6th, 7th, 8th company stand in that? And at the moment, the 4th to 8th company are massive buyers of NVIDIA chips. So I think the risk for NVIDIA is that we're in a moment where there's just this there's everybody just buys too many. The order book fills out, and then the end demand isn't there. The companies then have to sell their chips on the market, and then you get a big fall. Like if the wheels fall off NVIDIA, it'll be something like that that's happened. But that's interesting. So cycles many times.
Yeah. So another thing that fascinates me is I'm amazed at just how sort of small this market is in terms of the number of players in it. Like there's the second tier, like everything. But if you look at the sort of the chain from NVIDIA to the design to, Taiwan Semiconductor, which is, from what I understand, and correct me if I'm wrong, is the maker of this, and then ASML, who's the, almost like the printing and company that prints all this stuff. When I say prints the, the chips. Is it literally, without one or the other, this sort of whole thing, I wouldn't say falls apart, but is it those sort of three companies, and then it's a pretty big, is it a fair assumption there's a pretty big gap to the, the second tier players?
Well, I think it is interesting because basically in each of those components, there's one leader, right? It's Taiwan Semiconductor. Samsung is kind of a number two there, but they also compete with everybody. They design their own chips, and so people are much more comfortable in general, or historically been more comfortable using Taiwan Semiconductor, which is purely a fab. They just make them. Similarly, ASML, they're the only people that make those printing machines, as you say, that make the chips. And they have, there's only one firm that can make lasers good enough for them. I think the answer as to why there's only one is that this technology is just so advanced. It's probably the most advanced technology we've ever done as a species, and it needs the whole world to have one Taiwan Semiconductor. So, the United States used to make chips, and by the United States, I mean the government used to make their own chips. And you can imagine the advantages of that. If they were doing their own chips, they would know it's secure, they're not made in Taiwan, they can do whatever they want with them. There's so many advantages for the government making their own chips for defense, for example. But even the US government isn't big enough to do that. It doesn't make any sense for them. The technology is too advanced, the CapEx requirement is too large. You really need almost the entire world demand to have one TSM. And then the entire world of demand for chips to have one company that can do what ASML can do. It just really is that advanced, and the CapEx involvements are that high that there's only really one company that can do each of those things at the scale that's required. And people are trying. So the United States has come out and put some very harsh restrictions on China. And so the Chinese are now desperately trying to replicate the entire semiconductor supply chain. And they haven't been able to do it yet. Probably in a few years they will. I actually think it's really short-sighted. I mean, the first thing the Chinese did when they wanted to to build an internet sector was to block access for all the foreign companies. Now, weirdly, and foster their own domestic market. Weirdly, in this instance, the US government has done it for them and basically restricted access to foreigners. So all those revenues are going to have to stay in China. And they made a national security concern of probably the highest priority to build their own competitors to every single Western supplier. Whereas a smarter move would have been to get the revenues out of China, foster the next round of R&D, get the next gen, build that lead. And if there was a defense requirement, then you could cut them off. But at the moment, just to give an example, like the Chinese government with all their state support doesn't have their own ASML. They don't have their own Taiwan Semiconductor of that scale that can make those advanced chips. So I really think it's a scale thing. You need like the scale of the whole world to have one ASML, basically. And that's kind of how the industry has played out. I think there's been so many booms and busts. So typically there'll be a boom and there'll be a bunch of competitors in semis, and then there'll be a bust, and only really the most capitalized survives, and they'll pick off the scraps, get the IP that they need from the others, and then go again. So there's been this period of consolidation. It's also in cleaning, it's in measuring defects, all the parts of the supply chain generally have one, maybe two people that can do it, and that's it. So it's very interesting. It'll come down in semiconductors, like the quality of the companies is not in question. The fact that most of them are monopolies or duopolies and should generate significant profit margins, that's not in question. What is in question is this cycle of demand and supply, and everybody over-ordering, building too much capacity. Then no matter how advanced you are, if there's overcapacity, the price is just going to fall. Chips will be sold secondhand at prices below the cost to make them, and then you go again in 2-3 years time. So funnily enough, there's a huge boom in data centers, but in personal computing and industrial and auto, certainly auto now, there's actually been still an ongoing bust. Smartphone sales have been flat or declining for a very long time. People are going from upgrading once a year to every 2-3 years. Actually, we don't know. All we know is that this smartphone cycle, everyone's been pushing out, their next purchase. So the bullish case is you actually get this continued data center demand, and then maybe next year everybody decides to upgrade the iPhones that they bought over the last 2 years. And then you get a boom in that personal computing as well as the data center. But that's obviously a hypothesis that may or may not play out.
Yeah, so the other question just off the back of that is, you look at a very high quality company like, and I'm using video again because I've got the stats here, but their max drawdown, I think in the last 25 years has been the best part of 90%, I think 89%. So crazy drawdown, right? And, you've seen, in that COVID era period, big drawdowns. Your perspective as an investment manager, how do you deal with that whole cycle of drawdown? And obviously that's a company with, one would say very high quality earnings, almost, to a degree, even if you look at the drawdowns of, Microsoft and Google, you've got hugely dependable earnings. They're still having these massive drawdowns. So how do you deal with that? And I mean, are you using financial models? Are you leveraging tech to deal with this, or is it purely research and using the old brain to make these decisions? Where does it sit in terms of tech versus old-fashioned investing?
Yeah, my answer today is very different to the answer I would have given you 2 years ago.
All right.
So what I guess to rewind, I'll give you my perspectives on it, and I have to go back, rewind the clock a bit. So about 20 years ago, there was that the original kind of .com boom and bust. It was all through the 90s was a great time to be investing in technology. It's a pretty high interest rate environment. There were multiple interest rate rises, falls, rises. It wasn't really, to do with that, even though that was the story over the last tech crash. But basically, there were a number of managers that massively outperformed because they were long tech. And there were a number of investors, some who ended up winding up, and then some which underperformed, like, for example, Warren Buffett, or the original Tiger Fund, which wound up during that period, who just weren't making those returns. And they looked like dinosaurs. They weren't on the trend. They couldn't see the future of the internet. And then the crash came. All of a sudden, the value managers, including many people in Australia, outperformed. And those were the funds that survived. And all the tech forward funds kind of went under and just didn't exist anymore. And these are things like, big funds like Perpetual, all the big managers at the big mutual funds in Australia, they were generally very deep value. They made their career in that bust because value stocks went up and everything else got crushed. And the more tech forward you were, the worse you did. And that was when you had those 90% falls, in NVIDIA, and 95% falls in other software companies, including the big ones like Microsoft, Cisco. So that then changed the whole industry. So basically what was left is a bunch of fund managers who are deep value. You kind of plodded along and basically after that went in line or slightly underperformed the index, ever since. And then obviously the way these things work is from 2003, say, tech just shot the lights out and, had a great GFC and just outperformed before. And then after the GFC, dramatically outperformed to the point where, there were times when the entire market return was basically a handful of tech companies. The FANG idea, that's been around for 10 years plus. Right? I remember reading about that in like 2012. Certainly like by 2015, 16, that was well established and it ran for years. And then the whole thing reversed and the managers that outperformed were the ones that owned those kinds of stocks. And then that kind of ran until 2022 when everybody kind of piled into that sector and the whole thing reversed. Now, from my perspective, I was part of that generation. I kind of graduated, when it would be, early, just after the GFC. So, started my career then. So we had big sell-offs. We had COVID, 2018, 2016, 2011, Euro crisis, but we didn't have like an extended 2-3 year drawdown. So my view was like, well, look at what's happened since. If you just held through that tech boom, you'd have made an absolute fortune over the following 20 years. That would have made those losses in 2000, 2002 look tiny and irrelevant. That was kind of my thesis. But then actually going through one of those 2-year drawdowns is very different. That's like a long time. And so I don't actually believe in that approach anymore because you just don't know. You don't know which ones, for example, COVID sold off. There was a big sell off. A lot of stocks dropped 50, 60%. But then government stepped in massively and hands out cash to everybody and the whole thing rallied. But it might not have turned out that way. We might have been in a period where the politics was austerity, which is what happened in Europe. Had COVID come at the same time as an austerity movement, it would have been a very different story. But it wasn't. It kind of came after the austerity people looked really silly and the Americans who stimulated a lot more than the Europeans after the financial crisis. The US did exceptionally well and Europe stagnated through that austerity movement. So the good thing for people, I'd say it was a good thing, was that the politics at the time was like stimulate rather than go through an austerity movement and cut costs. So these days, like in terms of, to bring it back to your question about like the way I view these things, I didn't study computer science, so I didn't have that coding background. Tried many times to learn. It always kind of hit like a roadblock where, you spend like 2 days trying to fix something and you just can't get through. And then you stop and you give it up for a few months. That was kind of like my history with trying to learn to code. With ChatGPT and these language models, you just breeze through those. You go straight through that roadblock. You can solve the problem very quickly. Just keep asking for different solutions, experiment, and you go through. So we've now built like risk models across our entire thing, our entire portfolio, which means that, we'll sell at very clearly defined levels in an extended downturn. And you might lose a bit if stocks chop and go sideways, but you'll never get caught. Like everybody got caught. All the tech managers got caught in 2000. A lot of value guys got caught in 2008, 2009. And I guess how we got caught in 2022. You'll always be safe from those multi-year drawdowns. It's also enabled us to kind of like ask questions that can only really be done with code. It's kind of like once you get beyond Excel. So I was kind of, the question I've spent the last kind of 2 years answering, or 1.5 years answering, is like, what are simple things we could have done to do so much better? We had like some of the top returns in the market. We're compounding at like 40% for many years. How can we like keep something like that while not having, a devastating 2022? And there's some really simple things. Like one of them was just sell things that go up 4 times. Like I remember there was one point we had like, I think it was like, it was over 10 stocks that have gone up more than 8 times, I think, in like a couple of years. And that was kind of guiding. That was one of the reasons why we were part of that camp a few years ago of just hold through these drawdowns. It was like, well, if you hold, you can actually go up 3, 4, 5, 6 times at the end of it. But going through all the numbers and like reviewing everything, all our trading decisions with code helped by ChatGPT, you could see that actually would have dramatically outperformed if we sold when things went up 4-fold across the board. And that's just like one of the heuristics that we've got, as well as kind of risk management. So now we have pretty clear defined levels that are dynamic, that move, where we would take profits and where we would cut risk. So that's kind of a change for us. And it's worked pretty well in the last year because it's kept us long. It got us buying in late last year, and there's been a huge rally across the board in semiconductors and growth stocks, not in the old growth stocks, but in kind of the AI related stocks and, you know, the independent growth stories that are still hitting 100% year on year. Yeah, it's really changed the way we operate in this sector. The stocks are still the same. The approach is still the same. We're still identifying the fastest growing companies that have customer love, that, you know, are bigger, better, and stronger every 3 months. But we're definitely putting a very tight risk framework and really using kind of models, AI, and computer science to generate when we actually buy and when we take profits and when we decide to close something because it just hasn't worked out.
So
it's pretty long answer.
You've got you've got obviously those big names, and I want to talk to you in a little bit about, you know, what you're seeing in some of these names that, you know, certainly probably Dex and I have probably not even heard of, even being in the tech sector, that, you know, probably what we would deem early stage, but probably not to you in terms of, you know, what you're doing. So how do you get a mix in terms of obviously those what we would refer to as known stocks, you know, keep coming back to it, the NVIDIAs and the Microsofts, and play a portion of the fund in those names, obviously in the right cycle, or what you deem is in the right cycle, and then there's a, you know, a portion of stocks that are you know, obviously in the main fund, but, you know, deemed early stage, you know, very very dependent on future earnings. Is that the mix, or do you aim for that?
It's pretty,
the explosive
close. I mean,
growth?
we've got our biggest sector weighting would be to semiconductors, and you recognize a lot of the names there: Taiwan Semiconductor, NVIDIA. But then we took kind of pretty large positions, say 5 to 10% positions in a handful of fast-growing companies, applying this risk model framework so we won't get caught out in the same way that we have, or we might otherwise. You know, these are companies. The perfect thing is you get something that's growing super fast, that has like a devoted fan base, and then it becomes a household name. You know, something like, I don't know, in Australia, it was Afterpay. I mean, they had I guess you could say lucky, you could say genius exit at the top of the market. That'd be a very different outcome if they didn't sell to Square. But, you know, that was a company that very few people knew, and then very soon was like, you know, front page news. That's kind of like the perfect growth play. You take something that nobody knows about, and then everybody knows about it, and they're 20 times bigger than they were, you know, 4 or 5 years ago. So companies that we've bought recently, things like Celsius, which is like an energy drink, a 0-calorie energy drink maker in the United States, which has been taking massive market share out of Monster and Red Bull. It's kind of like, I tried it in the US, and me and the colleague I was traveling with very quickly got addicted. It's like, it tastes a bit like orange juice, but with like a kick of caffeine. It's like having an orange juice and a coffee with no calories in the morning. It's very addictive. Another one was Nubank, which has now got over 100 million customers and barely existed like 5 years ago. So they've been on another phenomenal growth trajectory in South America. Our biggest position after it kind of just doubled recently was Transmedics, which is another independent growth story. So they provide organ transplantation services. So in the past, if somebody passed away or was in a state where, you know, they could be an organ donor, it might happen at 3 a.m. in a regional hospital in the United States. So somebody would charter a plane, a junior surgeon on the transplant team would travel out, extract the organ, put it in a bucket of ice, travel with the organ, and then in the surgery, there'd be a go, no go. Like, do we cut someone's heart out and put this one in? You know, it's a very tough decision to make. And obviously, if it goes wrong, it's catastrophic. Transmedics made a device. It was actually developed in Sydney. A lot of the core technology was developed at St. Vincent's, which allows you to kind of keep the heart alive. Actually, that's probably the wrong way of putting it. Pumping kind of warm liquid through it, keeping it beating on a machine, and monitoring its vital signs throughout. So it lasts longer. It can survive much longer than it would in a bucket of ice. And perhaps more importantly, when it gets to the go, no-go decision, you have some idea of the vital signs that you didn't have if it was just in the ice bucket. And that company's charging about $100,000 US for that. So vastly more expensive than the old solution. Now that is quickly becoming industry standard, and there's probably another 4x in growth of that just in the United States. Just as they roll that out, it becomes more and more the standard of care. And they're showing pretty good evidence that it gives better outcomes. Very hard studies to do because, every transplant's different. It's very hard to do a controlled trial. You can't do a double-blind trial because you obviously know if you're using the bucket on the machine. But they are starting to prove that it gives better outcomes as well. So the way the United States works is once you can prove those things and insurers pay it, then they will pay those high prices. So that's kind of an exciting independent growth story. And then what are the top stocks? The other one was Clarity, which was trying to cure prostate cancer in Australia. So there's a couple of there's one stock that everyone's familiar with here called Telix, which does diagnostics. So it allows people to test whether if there's recurrence of prostate cancer, basically. But Clarity it might have started as a copycat. Some people think it is a copycat, but it's very different now. So they actually got extremely good data treating patients. So prostate cancer is pretty nasty treatment regimen. Like many cancers, the cure is pretty bad. In this case, they'll remove your prostate. They'll give you hormone drugs that kind of stop you feeling like a man. And then if all that fails and you get recurrence, then they will give you pretty serious chemo. And the end result of that is a significant number of men who go through that are incontinent or impotent or both, which is obviously kind of depressing for men and not a great outcome, even if you are cured. Now, the radiopharmaceuticals that Clarity is working on, they're very specific. They still have side effects, like it kind of messes with your salivary glands, so you have a dry mouth, but they're getting extremely good results, effectively curing people, having people's tumors melt away and their prostate-specific antigen tests coming back clear, 6 months after. And this is after every other treatment has failed. So that's a really exciting company. And it's also interesting because there's a huge wave of M&A in the United States in that space because everyone kind of is recognizing that's probably the future of these treatments. There's a handful of them approved in the market. So there's Pluvicto for prostate cancer, probably works in about 30% of people. Again, but it's that last line. They've already gone through all that horrible surgery, that horrible hormone treatment, probably horrible chemo as well, and then you'll try this. Now, the future is almost certainly that advanced radiopharmaceuticals are moved to the front line of treatment. And it's one of the first things you get, just because it's more specific, has less side effects. And that's, I think, a ripper Australian company. So to answer your question, yeah, our biggest sector weighting is semiconductors. We're also trying to find these independent growth stories. They're really interesting and exciting in their own right. They're kind of independent of the market or what supply and demand does for AI in the future.
So, Michael, just getting back to sort of the unknown or the no-name companies that you were talking about just then, how do you go about deciding which ones to go for? Do you have advisors? Do you do your own research? Do people pitch themselves to you? Like, you seem to have quite a vast array of different technologies, medtech that you're sort of investing in. How do you decide which ones to go for?
It's a good question. I mean, I've always had a soft spot with companies growing 100% year on year. Like, if there's twice as many people using it this year than there were last year, there must be something going on. And actually, that's been pretty effective. Generally, the top performing stocks in any market kind of fit those criteria over most periods in time. The problem is that style became really successful for a while, and then companies started adapting to that. So companies started saying, okay, we may as well just spend as much as we can as long as we're getting that top line, and investors were buying it. And so a lot of companies listed a couple of years ago, but they weren't making money. The economics were negative. They might have showed 100% top line, but they were spending $2 to get $1 back. And at the time, people were very happy to give them that money. But a lot of those companies ended up not reaching that nirvana of making actual real money at the back end. You get to the end, your growth slows and you're still losing money. What do you do? And there's a lot of companies in that bucket. So I look for things that are really interesting, that I'm personally really interested in, that are growing really fast or have enormous opportunities. But you can't get away. The stronger the unit economics are, and the stronger the underlying, nuts and bolts, business 101, common sense, the better companies score or growth companies score on that, generally the better they'll do. Like, they have to be making money. They have to be making economic profits. The unit economics have to be good. And to the extent we've picked these well is when all those things align, where you had the growth, but you also had that amazing economics And the whole thing just made, fundamental business common sense. Yeah.
Interesting.
That's how we look at it.
Something else I wanted to touch on, it's probably not necessarily stock related, but as you said at the top, the whole investment management industry is hugely competitive. There's a fight, and I would imagine one of the challenges that you have in a fund like yours that has, and the stocks within it, as we said, big drawdowns, big gains, is trying to manage the sort of what we would refer to as the client journey, but obviously in your fund, it's the investment journey. As you always get these people that have it's very emotional. It's a bit like the property sector, right? It's they enjoy the big ups, and then all of a sudden there's a down, and people are exiting at precisely the wrong time. And as opposed to players in your industry that take a much more index tracking almost approach, where gains are a lot more steady and drawdowns are a hell of a lot more muted, for want of a better term. You seem to do, obviously, I wouldn't imagine you're immune to that, and obviously there's been played out over the last few years massively. One of the things that you do very well is the entire social media. You're very active on all the platforms. You do a lot of video. You do a lot of investor updates. Just talk us through that and that journey. Is it? Does that help you in your industry? That entire sort of, I suppose it's an education piece, really, isn't it?
Yeah, I definitely saw that firsthand. So there's no doubt, we raised most of the money at the top of the market. That's just what happened. We're trying to raise money for years and years and years, and all of a sudden, everybody, including friends and family, who literally followed me for 10 years. All invested in this short period of time. So that bit was true. What didn't happen is we didn't get a huge wave of redemptions, which surprised me. But it's helpful now that we've bounced, 100% from the lows. I'm glad, thankfully we didn't. I think it surprised me, but I think it was helpful that we're doing a lot of that media stuff. The efficiency is insane. We can do this podcast and you can send it out to every investor, and it's like you're having that conversation with every investor. We know what people are going to ask. You can give an update on the stocks, and you can reach everybody without necessarily speaking to hundreds of people, which obviously, though you would do it if investors called you answer, but it wouldn't work if you had 1,000. You had to do 1,000 calls in a week. It's just not possible. So I found that the social media stuff, putting things on, doing podcasts, going on YouTube, giving updates that way is extremely efficient, because you can speak to a lot of people at once. Having said that, we will obviously speak to every investor who wants to have a chat. But I found it extremely efficient in that regard. And it's probably why we didn't get that wave of redemptions, which I know typically that's the cycle in funds. But yeah, I guess for whatever reason, we just didn't see that.
Yeah, so
we didn't get that wave of redemptions.
This financial year, what are you sitting at, about 25%? Did I read? Was that?
We actually had a pretty ripper month. So we're about 42 for the calendar year now.
Wow.
But that's all come in the last. But yeah, the way it worked is we had a really, January and February really strong, and there was kind of a broad sell-off. And then the last kind of 5-6 weeks, everything was just ripped to new highs again.
Yeah. And so the fund itself is not a listed vehicle. Just for people that obviously, a lot of our audience is quite educated in this space, but for those that sort of are not, how does someone go about, investing in your fund? I know there's some limitations in terms of who can and who can't, and talk us through why the vehicle you chose, as opposed to say a listed investment company.
It's a good question. we're a wholesale fund, so people can just invest as they would a normal wholesale fund. But we've been wanting to launch an ETF for years, and we're actually about to do that. We're in the final stages of getting that ready. The ETF would be accessible by everybody. It would be retail, and ETFs are great because you can just buy and sell them like a stock. It's so much easier to invest and get your money back when you need it. You can see the daily price. So that will probably go ahead this year. Listed investment companies are a bit different. So listed investment companies, it was weird. There was a few of them. Apparently there was a boom, 15, 20 years ago, and a lot of them shut down, but a few of them lasted. But the windows for raising money in listed investment companies are really narrow generally, because they're very manager friendly, because the managers don't have to give the money back. And then the listed investment company trades freely. The window was open for a very long time, and a lot of listed investment companies were listed a few years ago, and then most of them traded at discounts. And now we're back in one of these long periods where nobody likes them, for good reason, because they're trading at discount. There's no liquidity.
Huge discounts to asset value, right? We're seeing
ETF's a bit different because you've got like a market maker, a managed ETF that keeps the price in line with the unit price.
Right.
And they offer liquidity.
So it's tracking the underlying asset value much more closely.
Correct. So much better product. And it gives you the advantage of, really ease of access, easy to get in, easy to get out, which isn't the case with all funds. So yeah, that's a new thing. So I haven't told many people that that's in the works, but it is.
Very, very interesting. Very interesting. Now, look, I've been, obviously tracking you for a long period of time, and it's fascinating because we sit on the tech side of sort of, obviously, we do a lot of tech day to day for small, medium, and some really quite large businesses. But we don't sort of focus on the investment thesis or, what's happening behind the scenes. We're using very much the front end of product, Microsoft's, Google's, CrowdStrike's, the security names, and there's such a layer beneath that. Just to be a little bit selfish, obviously, we've got we utilize a number of these big things, if you pick out a Microsoft or a CrowdStrike, for example, these are companies that are posting massive, still hugely mature businesses, and obviously, but it's still doing massive amounts of growth. From your perspective, are they companies that are still investable in your universe? I mean, they're obviously they're much more mature.
I think CrowdStrike is one of the best software companies. It has kind of reached that profitable point. It's still growing pretty fast and it's making real money. I'd be interested to know your perspectives. So the CrowdStrike, Zscaler, are these companies that you see as IT experts, and what are your views on those?
Yeah, well, I mean, from my perspective, it's interesting because there's really two ways to look at this. You've got these companies that are being used across the spectrum of client base. If you pick out a CrowdStrike, for example, they've obviously their players been big corporate enterprise grade security, very strong in that market. But what's interesting to see, we obviously procure our products from intermediary suppliers, from, for example, the likes of Digger Data and Pax8 in Australia. And up until sort of only in probably the last 3 to 6 months, a product like CrowdStrike, we could not even procure for a customer. They wouldn't even talk to you. So, the segment of the market that they're addressing and they're servicing and unless you've got, 200-300 seats, maybe even more, it may have been 500 seats, they wouldn't even say hello to you. You couldn't even get them to answer an email, right? Despite, we went to them a number of times and said, look, what if we bundle up all these customers and, give you 2,000, 4,000, 5,000 seats, no talkie. So really fascinating. But the big shift, I don't know how this, and another one is Cloudflare. You could not, apart from the basic service on their website, you could not get any sort of multi-customer platform or mechanism to engage in their services. Again, just simply wouldn't talk to you. So what has changed in the last 3 to 6 months, if you pick out those two customers, is our ability to access their services. And obviously what that tells me is, and that's the same in the United States, if we talk to any partners in the United States, they had the same challenges. But we're now starting to see that these companies open up and our ability to provide these services to small and medium-sized enterprise where, these levels of protection, albeit scaled down to what is, the enterprises use, is now available. So you would think that would flow to, underlying earnings. And I'm not sure from an investment perspective that's getting a lot of exposure, but obviously their addressable market has opened up significantly over that time. So it's interesting. I mean, you look at CrowdStrike, which is a very expensive product comparatively.
How expensive are we talking?
if you look at their complete package, you're looking at sort of $80 or $90 an end user, per user per month. Now they've got platforms that are scaled back platforms. That's very all encompassing sort of platform, but they're bringing those things down to sort of half that or under, depending on how it's packaged up and sold to a customer and managed and all those sorts of things. But it's for the small business. The problem you've got in the small business, and rightly so, you've got everything has become software as a service. So most people have got Microsoft or Google for core platform, email, Teams, Zoom, those sorts of things. Interesting to note that Microsoft has split the teams. If you take out a new agreement with Microsoft, you now no longer get Teams included. You have to pay for that on top. So it's another $10 a month. But the point I'm making is, I think
the regulators forced their hand there.
Correct, in Europe, yeah.
It's too late for Slack. Too late for Slack.
Yeah, correct. So you look at that and you've got $10, and if you take out a Microsoft Premium licenses, which gives you all your programs and a baseline level of security Microsoft wise, you're at sort of circa $40 there. You do some email filtering. You've got another $5 a use. You do some security testing and training. You got another $10. This adds up, and then all of a sudden you want to come along and add another 40 base price, $40. These organisations are spending platform cost minimum $100, $120 before you get anyone to even service or manage that. So it's becoming very expensive, and it's a challenge that we've got. Having said that, it's a huge advantage to these organisations that they've been able to build out a model that is now serviceable to smaller parts of the market. So it's interesting. One thing that I would note that is interesting on the data center play, obviously, you strip out large organizations, and I'd be interested to hear your thoughts on this, is we're seeing a big move from public cloud. So for an organization that has still a lot of data and a lot of compute in public cloud. So there was a big shift, in the last probably 3 years back to 10 years, move everything to the cloud. That is hugely expensive. There's a lot of benefits to public cloud. You get the ability to scale up and scale down. But if you have, for the average business that has quite static requirements, even with small growth, the economics of bringing that back into what we refer to as private cloud, so private infrastructure sitting in a data center, I say everything old is new again. That's exactly what's happening. So from that perspective, I can see the explosion in data centers. In terms of the economics of data centers, are they, obviously they have fairly relatively, apart from the unknown of what the growth is, are they fairly dependable businesses? So what's the investment thesis around data centers?
It's a good point. I mean, it's interesting. I'll share some stats that we got from a call with Microsoft recently on that. It's interesting you say that people are moving back, because for most people, not for most people. I imagine for a lot of people, it probably does make sense just to buy a few servers and stitch them together. And think about the complexity of AWS. It's not easy to use, or you basically need engineers that just specialize in setting that stuff up. And then, wow, like you leave, like even if my little projects, you leave something running in the wrong way, all of a sudden you get slogged with these huge unexpected bills.
Massive.
Great for those businesses, but you probably prefer just to buy an extra computer and run everything like that. Anyway, yeah, it's interesting to hear that from you as the IT specialists. Yeah, so we had a chat with somebody at Microsoft who's a chief architect, whatever that means, but they're involved in their data center build out. So these were the numbers he gave us. He said they have about 192 data centers. A few years ago in 2018, they had a plan to build 100 over 10 years. They're now doing more than that every year. They're going from 192 now to 800 by the end of 2028, which isn't actually that far away. It's like 3.5 years. They're going to 4x their increase in data center capability. He says they switch one on every 3 days. Obviously, it takes longer than 3 days to build these things, but because they're doing 100 a year, every 3 days or so, they switch them on. They're at capacity in a few hours. Within 5 hours, the capacity is just completely taken up. So where we are today, the demand is definitely still there. And I asked him, I was like, okay, so I wanted to get those numbers that you told me, like what are the actual economics? And he wouldn't share. He probably already shared too much. But he did say it was well within a year. Like they pay themselves off within a year. So in effect, the return on capital is over 100% for that. And I've seen people run the numbers on NVIDIA, like you buy an NVIDIA chip and then you rent it out at the price that AWS and Microsoft are doing. The returns are still exceptionally high. So that's kind of like what's driving this whole thing. Like, why are they spending so much? That's because they can buy a NVIDIA, they can buy it from NVIDIA, spend 40,000 US and earn at least 40,000 over the next year, or whatever it is. You know, it's all those things are kind of hidden, and then the pricing is not transparent. The actual prices are well below the list price. So you kind of have to do back of envelope. But right now, it's extremely, even though NVIDIA is making such high margins and they're twice the cost of, say, AMD, it still generates huge returns for the hyperscalers to buy those and rent them out on AWS, Google Cloud. And at the moment, that's running at, I think in this year, it's going to be just under 200 billion from the hyperscalers. And interestingly, like Meta is neck and neck with Microsoft. And the reason why that's interesting is Microsoft, Google, and Amazon have cloud businesses. They rent them out. They rent their compute out. Meta doesn't. Facebook's just using these themselves. So it's really interesting that they're making such a huge investment. And
for
so
the
that's
consumer
like roughly,
market, Michael? So obviously Microsoft, Amazon, Google, they've, obviously hugely, corporate focused and what have you. But what's Meta using them for?
Presumably Facebook, Instagram, and WhatsApp. I mean, they're big businesses, right?
Metaverse.
Yeah, I mean, the metaverse. Yeah, I mean it's hard to know how much of that. I think they originally did all those orders for the metaverse, and then it just so happened to be very useful for this. So all those, when Facebook absolutely got smashed and dropped 75% or whatever it was on those huge spend on the metaverse, they were buying, NVIDIA chips, which ended up positioning themselves perfectly for what came next. So it's really interesting. And that 200 billion that a year that the hyperscalers are spending, that excludes Taiwan Semiconductor, which I think has said that they're going to do over 100 billion over 3 years. So add on another, 30, 40 billion a year from Taiwan Semi. And then you've got to add in ASML and everybody that supplies ASML. And then I think at the moment, there's over 200 billion of subsidies from governments for chip making. You're talking about, this is one of the biggest build outs of anything ever. And it's all happening in the next 2 to 3 years. Now, will there be an oversupply and a crash? Possibly. Hopefully, our risk models will hopefully get us out before the worst of that comes. Or even better, we hit our 4x profit targets on everything and the fund's up 3 to 4x, which would be ideal.
You're out.
But this is, regardless, investment aside, just watching this, just seeing these numbers, just Microsoft quadrupling the data center capability in a few years, it's a sight to see.
Absolutely crazy. Well, I think we'll wrap it up there. We could talk for hours, and we'd love to have you back on because it's a fast-moving area. Again, as I said, it's one that we get asked about a hell of a lot, and you just don't know where the money flow is happening. We can see it from our end. You don't need to be blind Freddy to work out that Microsoft and Google and the companies that you interact with are just doing massive numbers. We're only going to see the growth of data that we put in the organisations that we deal with, just on a data perspective, into these organisations and the capability that they need to build it out. Michael, where do people find you? How do they come across you? Obviously, learn about the fund. You probably don't need to do too much searching on the internet, but give us a few hints.
There's not many Frazis around. There's a couple, but not many. I'm Michael Frazis on Twitter or FrazisCapitalPartners.com. Yeah.
Wonderful.
Should be easy.
I really appreciate you coming on. We'll have you back on. Huge amounts of interest in this area, and can't thank you enough. So thanks very much.
Hey, thank you, Tom and Dexter. It was enjoyable. Thanks.
Very good.
Thanks, Michael.
Thanks.